Welcome to this technical webinar from Radisson Mining Resources on the news of this morning, which is the first modern mining study published on the O'Brien Gold Project. It's a preliminary economic assessment. We got about 45 minutes here of technical slides. I'm Matt Manson, the President and CEO. I'm joined by David Ross here, who's our VP of Exploration, and Albert Perrin-Bouchard, who's our Chief Financial Officer. We're coming to you from Radisson World Headquarters here up in the township of Cadillac, right on the project site. And if we're disturbed by noise during this presentation, that's because we've got core cutting going on outside this window here. And on the other side, we've got trenching going on in the trees just behind the offices, where we're actually opening up bedrock over the Cadillac Large Lake break and the deposit right beside the offices. So hopefully we won't be disturbed too much. I want to, just in terms of how this works, is a Zoom call. We can't see you, but we can see your questions. So please type in a question into the appropriate part on the Zoom app, and we'll field those questions at the end, and we should have some time for questions at the end. So please do that if you have a question. Forward-looking statements, I'll ask you to read that in your leisure. There'll be a recording of this presentation available on our website and on social media after the session. Qualified persons here, this is a preliminary economic assessment, and we're also talking about certain non-IFRS financial measures like AISC and things like that, so there's language about that too. So this presentation is going to be in 3 parts. We're going to be talking about the PEA. Dave and I are going to tag team that session. Then we're going to be talking about exploration. That's going to be Dave. And then we'll talk about next steps. I want to give a shout out to the study authors here. That's Osenko, Innovex Flow, now part of Norastello, BBA, and SLR. And I want to give a mention also to IAMGOLD, who have been very collaborative and constructive, working with us on the milling assessment, on the Doyen mill that was the foundational element of this study. The study has been conducted independently by Radisson. But IAMGOLD, obviously, under that MOU that we signed with them last year, had been very helpful in facilitating that milling assessment at Doyen. Okay, so with the PEA, there's 3 important points that we want to stress that are the basis of the study. The first is that Doyen angle here. So the strategy is to develop O'Brien with off-site processing of our mined material and off-site tailings management. So for us, there's a number of different facilities in the region, but an obvious candidate to be looking at is Doyen. In September of 24, we entered into an MOU with IAMGOLD. Doyen is the mill attached to the Westwood mine. It's 21 kilometers away on Highway 117. So this study is predicated upon that thesis. We're also, second important point, we're using the existing mineral resource estimate from 2023. We haven't updated it with any of the new drilling that we've conducted since that time. And that's an important point because we are having success with our drilling. But we've used that existing block model and right-sized it for this PEA, and Dave will take you through that. And so for that reason, then, you should really think of this study as a snapshot of a study that's continuing to grow. Dave and I were going over these slides yesterday, and Dave said, well, everybody says the project continues to grow. And everyone says that. Ours really is continuing to grow. So this is a snapshot here of that project. It has a 50 to 60,000 meter program of drilling underway right now, fully funded. So the results of that, when you do that on this PEA, you get a very high value project. You can imagine that if you're developing a mine and you're not building a dedicated mill, you're not building a dedicated tailings facility, you're getting a lot of value with a relatively low initial capital cost. So the value attributes of this project are really important and really impressive. We're also building something which has a relatively small environmental footprint, right? Minimal surface facilities, fully underground on a brownfield site, right? So that's an important attribute when we're thinking about environmental assessment and permitting and timelines to getting this thing into production. A really efficient use of capital to develop this project as well, because of all of those attributes as well. So a very high ratio of value to cost. That's in our business, that's called capital intensity. And that number is over 3. And that's an important measure with fundamentally good a mining project is. This one is really good. Okay, so the headline numbers in the study, $530 million of NPV at a 48% rate of return after tax, 2-year payback. That uses the current long-term consensus price for gold and exchange rate. So we use 25.50 for the financial model. That's what the long-term consensus is. Spot, of course, is higher than that, 3,300 as of this morning, 73 cent Canadian dollar. That also includes a conceptual toll margin here of about 30%, and we'll talk about how that's established. We've used, on the bottom right of this slide, since I'm talking about gold price, we've used $2,000, a lower number, for the mine design, the mine optimization, and for thinking about mineral resources, right, in terms of using that existing block model. So I think those are pretty conservative assumptions you'll be using. So the initial capital, of course, $175 million, that low number, because we're not building a mill, we're not building a tailings facility, and you've got a healthy AISC here of about $1060 US per ounce. In terms of mine life, using that existing resource, we've got a robust 11-year mine life here. We're mining about 740,000 ounces initially, recovering about 650,000. So we're delivering in a steady state, the steady state sort of period of that 11 years, which is years 2 to 8. We're delivering about 80,000 ounces of gold to the mill annually and recovering about 70,000. And because of those margins, we're doing almost $100 million Canadian of free cash flow in this project at that 25.50 gold price assumption. So, a healthy project, good numbers. So just to remind you where we are here, we're in the Abitibi in Quebec. There's Rouyn-Noranda to the west of us. There's Val-d'Or to the east. We're just off Highway 117, the Trans-Canada Highway. We use this map with the red shaded areas to show all the existing hub and spoke mining operations in the Abitibi. When we propose that O'Brien be developed on the basis of off-site infrastructure, off-site mills, we're not reinventing the wheel here. This is the characteristic style of project development in the Abitibi. Those red hatched areas are all the existing examples where multiple mineral deposits have been sent and processed through an existing mill. Some of these mills have been around for several decades. So you got Doyen Westwood, that was originally the Doyen mine, and then it was Musca, more recently Westwood. It's been the Grand Duke ore body, and we're now using that as an example of another one, O'Brien. La Ronde was the mill by which Lapa was processed. La Ronde mine is the original, of course. Bousquet is there. You've got Malartic, it's just that. So Agnico Eagle just purchased 03. That's going to be hub and spoke. You get Sigma Lamaque, the Sigma mine and mill with the Lamaque deposit, El Dorado. So, single mines with their own infrastructure are the exception in this area. The hub and spokes are the rule. And of course, for our specific local neighborhoods, we've got two, large and impressive, mines adjacent to the project. We've got the La Ronde complex with Agnico Eagle just over the back fence. And then we've got down the highway, we've got Westwood Doyen with iron and gold. And of course, that photograph shows you how close everything is. This image also shows you the large land position that Radisson has, this exploration position that we have in the hanging wall of the Larder Lake, Cadillac Break, to the south of us, where we had an exploration focus as well. But this study in the PEA is really based upon the O'Brien project at the top of the land position, just beside the community of Cadillac. Okay, so our starting point with this study is what does the rock look like? What is the deposit model? So this is quartz sulfide veins within the Piché Formation, adjacent to the Cadillac Larder Lake Break. We get quartz sulfide veins within altered zones. We've got a biotite alteration. We've got disseminated pyrite, arsenopyrite, and we've got quartz. And we have a lot of coarse free gold. When I first joined the company about a year ago, we got a lot of questions about the refractory nature of the gold. Is your ore refractory? I've heard it's refractory. We got a lot of questions about arsenic because of the arsenopyrite. And so those questions were addressed head on with the metallurgical work and the milling assessment that we did, under that MOU with IAMGOLD, looking at the viability of sending O'Brien rock to the Doyen mill. So that MOU was signed in September of last year. The work was done under Ausenco's supervision, and the metallurgical work was done at the Lakefield facilities of SGS, and published in early February. And the results were we were seeing recoveries of about 86% at the low end, up to 96% at the high end, with a number of different flow sheet options, all of which were compatible with the Doyen mill, with minimal to modest additional capital. And so that kind of, established, the first question well answered, right? Can you recover the gold in the rock? Well, yes, we can, right? It's good numbers there. Second question was in the arsenopyrite and the arsenic. Well, those numbers are 0.4 to 0.5% in the whole rock, 4.6% in a flotation concentrate. Those are very typical numbers for deposits in the Abitibi of this type. So again, nothing particularly new or special here. The first number, 0.4, 0.5%, is relevant if you're sending your material to an on-site tailings facility, which is what we're proposing here. The second number, 4.6, is relevant if you're selling a concentrate after flotation and you're dealing with an offtake agent and a payability factor for the content of that concentrate. So again, quite typical numbers here. The analog for this project is actually the Lapa mine of Nicoego that ran between 2008 and 2018 that had similar metallurgy and mineralogy and similar numbers in this regard. So what we've done in the PEA then, our base case flow sheet is gravity, flotation, regrind, and leach. We had about 90%, 91% recovery in our met work with that flow sheet, with the grade of the metallurgical sample we have. We're assuming 87% with caution in the PEA based upon the mix of material and the grade of material we're sending to the mill. And we assume that will be about $21 million of capital investment to upgrade the mill on that basis. And of course, tailings deposition into the existing Doyen tailings facility. So I'm going to pass this over to Dave now, who's going to talk about the next stage in the PEA process, which is what we've done with the mineral resource block model.
Yeah, thanks, Matt. Yeah, this slide shows compares the older resource done at a 4.5 gram per ton cutoff to the new resource that reports at a 2.2 gram per ton cutoff. That's the single biggest change in reporting the mineral resource at O'Brien. The block models is basically the same. There's a small tweak to it. We changed the height of the blocks to allow some optionality in the mine design. But other than that, the drill hole database, the wireframe interpretation, and the block interpolation methods are all exactly the same. This is work from Luke Evans at SLR. And so with this lower cutoff, this is how we see, after the engineering work we've done, we see the project as, bit lower grade and bigger tonnage project. So you can see here the indicated resources, there's almost a 50% increase in tonnage. Now, the reason that the grade comes down is because we're adding tonnage between the grades of 2.2 and 4.5. So that means the new tonnage is going to be, the average grade, the new tonnage we're reporting is around 3.5 grams per ton. So that brings the grade down from 10 grams to 8 grams. Same with the inferred side. We almost have, we triple the tonnage here. And again, we're adding in an extra 5 million tons at about 3.5 grams per ton, which adds in 500,000 ounces of gold. And we see this is a good opportunity on a number of fronts. It improves the continuity, which I'll show you in the next slide. But it also is giving us some drill hole targets in that inferred. The inferred, in general, you can see throughout the history of different resource estimates, the inferred grade tends to be a little lower grade. And that's probably than the indicated. That's probably because it's wider space drilling and the drilling has not hit the high grade chutes as much as the closer space indicated drill. So we like that aspect of it. And next slide. And then as a resource geologist and explorationist, the one thing I like to see is the continuity of the grades. Here we're showing that you lower the grade, cutoff grade to 2.2, the continuity of these mineralized zones, it's much better laterally and by thickness. So this is in effect will de-risk the mining of the ore body for the mineralization. I think it's back to you, Matt.
Yeah, okay, thanks, Dave. So having established the metallurgy, the flow sheets, we've right-sized the block model for use in this mine design. Here's the mine design. So we've started with a desert slope optimizer, DSO optimization process using $2,000 gold, right? We design the stopes. This is narrow, high-grade veins. So we're talking about a 2.2 minimum stope width. The average stope width is about 2.7 meters. So this is long hole stoping. There's contemplated to be a cemented rock backfill. There's 86 kilometers of development on there, 25 meters between the levels. We reblocked the resource model at 5 meters, so allow us to run some different sensitivities on development levels. We're not using the old infrastructure of the O'Brien mine. We're developing new infrastructure in the east part of the property, twin ramps to maximize mining efficiency given the distribution of the resource. Whilst we're not reusing O'Brien infrastructure, we are reusing the infrastructure of a smaller, more historic mine called Kawagama on the eastern side of the property, which we're going to use for ventilation. The bottom table there shows you the color coding of the different classifications of rock here: production stopes and marginal stopes, high grade development, which is development within stopes, low grade development, which is where we're developing through veins to reach a stope, and the waste, the numbers. So you see here that our head grade is 5 because we're averaging the higher grade stopes and the lower grade development rock and the more marginal stopes all together, right? We're going to process everything. And that's an important point here because the production rate, which is what you always start with when you're designing a mine, getting the production rate right size for the deposit. So for us, that is 1,160 tons per day during that steady state period, years 2 to 8. But we are assuming here, because this is predicated upon the assumption that we're using the Doyen mill, that there is up to 2,000 tons a day of capacity to receive ore from this project. Based on IAMGOLD's own technical disclosure and technical reporting on the Doyen and Westwood complex, you understand that there's about 1,000 tons a day coming from Westwood. There's 2,000 tons a day into the Doyen mill coming from the Grand Duke deposit, which is scheduled to finish before we would appear here on the assumption that this Doyen mill is the destination for O'Brien material. So on that basis, 2,000 ton a day of capacity. So everything that comes out of this project goes to the mill, including low-grade development materials. We don't stockpile anything on site. That gets the production up to 1,410 tons per day during that year 2 to 8 period at that 5 gram per ton average grade. That's why we have that grade. And also eliminates the need for low-grade stockpile on site, which is a significant cost saving. The graph there shows you how ounces relate to production stope and development material and how grade relates to that as well. And the graphic is showing you the time sequencing of the development of the mine. So this is a really elegant way to do it. In terms of classification of rock in the mine plan, it's about 50-50 indicated resources and inferred resources. This is a PEA. So there's inferred resources in the mine plan. I refer you to the cautionary statement that goes along with that statement. And it's about 50-50 here throughout the mine life. So there's some significant infill drilling to be done here to convert this all to an indicated resource, to get a mineral reserve, to get a feasibility study. That's ahead of us. But for this early stage PEA level study, you know, this is quite appropriate and looking good. Now, of course, site facilities here are, this is an underground mine right in the heart of existing mining communities, mining services, contemplating the use of off-site facilities. So no mill, no tailings facility, no camp, No major surface maintenance facilities, underground maintenance facilities for equipment, but not on surface. We're contemplating a relatively small footprint to the east of the historic mine. We're going to stay away from the old crown pillars and what's of the old mine site. So 2 kilometers to the east, twin portals, lay down pads, run a mine pad, waste rock pad, trenching, water treatment. That's it, right? Small footprints, very compact, right? We're right beside the Hydro-Quebec power line, so we're contemplating a new substation to tie into that. And a lot of existing infrastructure and roads. There are some new site roads designed, but again, pretty minimal. In my career, I've done a lot of project development here where you did a lot of access infrastructure, roads and power and airstrips. None of that here. No camp. We're surrounded by mining communities here, off-site services for floating equipment in and out. So really ideal location. In terms of the numbers and the costs, this is how it builds up in terms of the CapEx and in terms of operating costs and AISC. Now, it's important to note that the process and tailings OPEX has been built up from first principles. Ausenco are the lead agent here on that part of the study, but it's designed to track existing numbers reported from the Doyen mill. We can't be reporting numbers less than the Doyen mill if we're predicating a study based upon sending a material to that mill. Same goes with G&A, right? That's designed to be not less than the existing operation down the road. The process toll assumes a 30% margin on top of that processing and G&A OPEX. So full build up for that attribute of the project. And that's based upon market precedents again, recommended by Ausenco. I stress that there's no existing contractual arrangements between ourselves and IAMGOLD. This is an independent PEA authored by our consultants. In terms of mine haulage and water management and mining CapEx, that is most of the cost here is in the development of the underground mine and the operation of the underground mine. So this has been built up by Novexplo, now part of Nordistello. We're very happy with the numbers. If you wanted to stress test these numbers, we're in the mining business. We all know that costs go up every year, and there's cost risk going from studies through builds to operations. So if you're looking at this set of numbers here, because we're tracking existing operations for the processing and the G&A, the risk is really in the mining cost buildup, right? And if you stress, and there's healthy contingencies throughout this, right? But if you wanted to add additional contingency and stress this, I'll tell you what that does. If you add additional 50% contingency to your mining costs, because that's the identified area where you're not tracking existing operation, you're adding about a couple of $100 an ounce onto the AISC, right? If you really stress test it. And so the message there is that this is a robust cost buildup. And if you really stress test it, you're still getting a project with an exceptionally high margin. So again, we're happy with how this has been done. Okay, so in terms of valuation and sensitivities then, 532 is the NPV with that toll. Without the toll, you're getting about 580 million NPV, so the toll adds about $50 million onto the valuation of the project, or it takes it off. 3 times value to CapEx, 2-year payback. If you use spot, 3,300, you're almost about $900 million of value, huge IRR, 74%, a 1-year payback, with average cash flow up near $150 million Canadian. In terms of operating parameters, least sensitive to the initial capital number, most sensitive, as most projects are, to the revenue numbers. So that's exchange rate, grade, gold price, those types of numbers. Now, we're presenting also a development plan here. This is a fully formed preliminary economic assessment. And so we count back from construction in this graphic. So if you go down to the bottom right, you've got early works for 6 months. We've got a 15-month construction until we get to commercial production. So our capital number, 175, is a 21-month number that goes from the early works through that 15 months of construction, and then operation at the end of the first quarter of year 2. So counting back from the beginning of construction, you've got about 3.5 years, or counting back from the beginning of the early works, 3.5 years of engineering studies, baseline environmental work, which has already commenced, leading to environmental assessment, permitting, and development of management plans and preparation to start construction. Community consultation with our community neighbors, with First Nations, and with stakeholder groups, throughout that period. So that's a pretty healthy timeline, again, reflecting the scope of the project and the footprint of the project that we're presenting here. So I'm going to turn this over now to Dave, who's going to talk to you about the exploration and some of the optimism we're seeing here for the future of this deposit, this project.
Yeah, thanks, Matt. Yeah, as Matt mentioned earlier, the PEA is a snapshot of where we are in terms of growing the resource at O'Brien. First slide here is regional geology. We're in the heart of the Quebec Abitibi. Abitibi is a very well-known belt throughout the world, having produced almost 200 million ounces. It's probably another 100 million ounces in resource unmined material and resources and reserves. So it's a good part of the world. Next slide. This, again, a bit of a geology story here, shows our neighbors. Matt's already talked about LaRonde and IM Gold's operation at Westwood. The top is a level plan map of our property with respect to the Cadillac break. We have about 5 kilometers of that break, and that's where O'Brien sits, along with a few other deposits that we work on. And one thing I'll point you to, the bottom image is a longitudinal vertical section showing our neighbors and how deep they're mining. And then you can see O'Brien is really underexplored or not explored at depth. And we see that as a real opportunity for us to grow the project. And we think a reasonable depth for this is 2 kilometers. So basically doubling the vertical depth. Next. There was a mine here, of course, in the past. The historic O'Brien mine operated from 1926 to 57, and then plus a little bit in the late 70s. Here's a very interesting table showing production of O'Brien and some of the other neighbors. The units there, kilograms of gold produced. But it's been done before. There's been a mine here. It's the first one in the region, and which proves up a lot in terms of de-risking the project. Next. And one thing from a geologist's perspective is how are we going to leverage that information from the old mine? In the top left, you can see a 3D model of the old mine, and this is about more than 30 level plan maps of the old mine that the old time miners had made, and very meticulous mapping of the lithologies, of the veins, of the vein geometries, of the grade. There's notes on these maps where visible gold is, thicknesses of the veins. And so it's just a treasure trove of information that we apply to the O'Brien East mine, which is the basis of the PEA. Top right is we take that information, put it in 3D, we create some lithological models, we model the old veins, and you can see 2 features that show on the top right. One is the Z fold. That's where the veins tend to thicken and have good grades, and also at the intersection of 2 veins. Those are 2 exciting areas. The other thing you can see is, the veins have pretty good lateral continuity, and that's important to remember too. Most of our mineralization is hosted in the Pichet structural complex, and that's another thing to remember. Next. So I mentioned that these Z folds of the veins and also the vein intersections are 2 exciting areas that we want to target with the drill. and showing on the top left, those are the pink, those modeled from the old level plans. And we're starting to put together these high-grade chutes in 3 dimensions that were found in the old mine and mined in the old mine. And what do they look like? So they're very almost vertical, and they plunge a little bit to the east. And that's a great target for our drilling. And also, when we use that information in the resource modeling, we want to make sure those types of features are reflected in the new resource model. Next. And reflect, and this is a great verification step and proving up these high-grade chutes. So this is work by Roger Blay, the PhD to U of T in 1954. And the image on the left is a longitudinal vertical section within the historic mine. You can see the shaft there, the vertical shaft, and then the horizontal developments. And in those developments, they would have mapped and sampled. And Roger took that information and plotted it up in 3D contouring by hand in those days. He did a great thickness type thing. And then you can see where the metal is. That's an accumulation map, so that's showing exactly where the ounces are located. Hotter colors, higher grade, more thickness. And so we took that and we digitized it and put it in our 3D model of the mine, because of course we have a large archive of paper maps here that have all been digitized and brought into modern softwares. You can see in the mine what it looked like, and we can plot that on the old stopes. And then the value of here is that's what it should look like, and then we can compare it to the modeling we've done at O'Brien East, which is where the PEA is, and that's shown on the right. So you got a comfort that the model you're producing from drill holes only looks like what was produced at the mine. The top left is some museum quality pieces that we believe are sitting in the Royal Ontario Museum in Toronto somewhere. One thing to point out, the jewelry box stope. This is an extreme example of the high-grade chute at an intersection of 2 veins. It was mined, and it was certainly a high-grade stope they chased for a few hundred meters. And of course, we've gone to look for it. We've drilled it. We've started to drill that area. One of the holes in late last year hit hole 347. There was almost more than 1 kilogram per ton, over 1 meter, and very splashy, visible gold, coarse gold, showing the 4 pictures in the bottom. So we continue we will be drilling that again, probably in the winter. There's some logistical issues there. There's a swamp, needs to be frozen, etc. Next. Okay, so this is what the resource looks like. And I forgot to mention this in my first part, is the PEA is solely on O'Brien East. So in the block model on the right, where most of the blocks are. We also have the Thompson Cadillac former mine and a small resource there. I think there's 160,000 ounces there. That's a good target. But I wanted to point out that the PEA is on O'Brien East only. So what do we think this thing can be? If we, given the budget and time and effort, geologists, we think it's going to be 3 to 4 million ounces. And that estimate's basically based on the ounces per vertical meter at O'Brien East that we have projected downward and laterally under the old mine. The grade 4.5 grams to 8 grams, we're just using our inferred and indicated grades at the new cutoff grade of 2.2. So that's a very reasonable target for us in the exploration team. Next. So how are we going to get there? Matt said this is a growing project. It truly is a growing project. This is a slide from a budget presentation we did in the fall. We asked for some money, and here's what we want. Here's our plan. It uses, the direction is deep. We're going underneath the old mine. There's 2 main trends there, underneath the known trends of the O'Brien East. And we're using a combination of a lot of pilot holes, few pilot holes and a lot of wedging and branches off those pilot holes using both iron wedges and directional drilling. This way we can reduce costs. And we're also using some existing holes as pilot holes. Anytime we can save money drilling deep, we do it. The plan is 50 to 60,000 meters, and that's fully funded. So how's it going so far? Again, that slide before was from the budget presentation. We are drilling these holes. You've seen the news releases, and it's so far so good. We have about as of May, we had 27 sort of holes intersecting the PEA group, and of those, 14 or so have been published, and they've all been producing excellent results. 19 and 27 holes have visible gold, commonly coarse gold, including 8 holes in the center of the screen there underneath the old mine at the deepest part of the image. That slide there shows the color scheme, the old color scheme and reports the old resource from 2023. But we're using it a lot for targeting. Next.
I'll just say that we used this graphic in a press release in May. Our drilling has progressed since then. There's a lot of drill results, queuing up here, and so expect to see a series of disclosures in the next, short to medium term with a lot of these results coming out. But again, I think since we did that graphic, we've got 2 more wedges completed in that cluster, wedges below the old mine, and that's wedges 8 and 9.
That's right.
They both also got visible gold in them. So I think we're batting 100% here for what's now 10 holes below that old mine in either the pilot hole or the wedges.
Yeah.
I'll also point out that in the mine, I'm sorry, I'm getting off track here. In the mine design, we are planning for success in terms of our ground conditions and rock mechanics and ground stability. The old mine had a very good track record for ground conditions, even though it was manual mining, cut and fill type thing. And our RQD, the metric of rock quality for the mining people out there, is very high in this project. But so we don't have an underground bulk sample yet. We don't have direct experience being underground on the new resource, developing mining practices. So that's a caveat. But all the data is pointing towards success. And a measure of that is the fact that we can do so many wedges and directional holes off an individual pilot hole at that depth. If the ground is bad, you can't do that, right? Because you lose the hole very quickly because you're pulling rods up and down the same pilot hole so many times. So we will end up doing 12, 15 wedges off these pilot holes. It's very cost efficient to do it that way because we're not having to drill 1,500 meter holes every time. We can do the wedges, but it's telling you something about the mining conditions as well. And I wanted to make that point.
Yeah, the deep drilling with the branching and directional drilling has been a great success. We got a good team of drillers, directional drillers, and the geologists planning these things. Can you go back? Sorry, go back to the plan is to, you see sort of the cluster of holes beneath in Mine East. The plan is to use that drill now to go shallower and join up with the stope. And I'll talk about that in a minute, but add a 4th rig to drill a deeper hole underneath that cluster and another whole set of branches beneath, down to about 2 kilometers. Okay, thanks. Again, it's been successful. Here's some published assays, some great grades. You can read through these. Yeah, it's been good. These are all in press releases. And as Matt said, more to come.
Yeah, and I'll point out the pilot hole that went below the old mine, 337, gave us 31 grams over 8 meters, including really hot zone in the middle. That was that pilot hole for that cluster of wedges below the old mine. That was the first hole drilled below the old mine in 70 years since mining stopped. and it gave us 30 grams over 8 meters. And now all of the wedges are hitting as well. So, we're not, when we show the visible gold, that's a proxy for geology, not a proxy for grade, right? But when you actually see the assay results that come back from some of these holes, they're excellent. So, we're encouraged.
Yeah. Grades are great, but you also need to, understand the model and the continuity of the grades. So when we're drilling it below the old mine and below our current trends in the resource and in the PEA, we're hitting this, it's more of the same. We're not hitting mineralization in some sort of other system. And that's an important point. We want to just extend our estimate of 3 to 4 million ounces assumes that this system goes to depth, and orogenic gold, they do that. So, and with this drilling, we're proving it. It's coming up the same sort of grades and thicknesses, etc., in the same units with the same alteration, so that we're happy to see that. The next slide also has something on the continuity, and as grades are great and that's excellent, but we also want, what's the continuity of the grades? Are they in a geometry that we can go mine? That's almost as important as the grades themselves. You have to have a continuity of geometric and grade continuity that permits mining. You can't have grades sort of everywhere erratic. You want them in some sort of mineable geometry. And that's what this is showing. This is basically a vertical cross-section cut. Looking west beneath the old mine in that same group of holes, that cluster we've been talking about, 337, that shows that these intercepts that we've been publishing can be modeled into veins with mineable continuity. The one sort of in the middle, is V3C03. That one is one of the better zones, standard alteration and sort of grade and thicknesses. And it actually extends up right to the stopes of the old mine, which is very encouraging. The one to the left, which is in the south, that set of grades in that vein extend up to, they had a cross cut in the old mine at the deepest level with some sampling on it. And it had some good grades in that sampling at the deepest level of the mine. That one extends to that. And then there's a zone to the north that they had some drilling off the bottom development drive. And that showed a zone in that drilling, and the other zones extend to that. So it's, we were seeing this bottom cluster that the hits we're hitting in 337 that we published, they align nicely with the bottom level of the mine and these level plans I've been talking about. So pretty encouraging, and it's certainly going to be fun to drill that gap between the old mine and the current published results.
I'm just going to add to what Dave was saying about this, and just to stress a point. So there's the old mine coming down with the main stope, and that is the original mapping of the bottom stope, the bottom development level, the 1,000-meter development level, where they stopped mining. And then 500 meters below, we're seeing multiple veins, which correlate to multiple veins at the bottom of the old mine. And they didn't mine multiple veins in the old mine. They mined one vein that gave them 0.5 ounce average grade. The other veins were 6, 7, 8 grams, and that wasn't ore to them back in the 1950s. And so when this mine closed, at that final development level, gold was at $35 an ounce. It's currently at $3,300 an ounce. And so that tells you why we've taken this approach to how we see this deposit. This isn't a super high grade but bespoke small scale thing. This is a much bigger system with multiple veins, all of which are mineable, with very strong margins in the modern era of technology and the gold price environment, right? So those are the spectacles that we put on when we look at this deposit. The next time you see this graphic, it'll be developed with all the additional wedges that we put into this area. As I said, we're now up to wedge 9, so 10 holes in total we've drilled through this area in that cluster, and we're seeing we're validating the model, and then we're going to do a cluster above, as Dave was saying, a cluster below, and demonstrate the the scope of this type of deposit, but it's relating very nicely back to the old mine and how the old miners saw this deposit. We're now bringing a different set of eyes to it.
Yeah, they certainly picked the eyes out of it, or high graded, so to speak, the old mine, and the new look at it, a better approach.
Okay, so just to wrap this up then, what's the next steps? So the day job for Radisson is the drilling. So, going to 4 rigs, as Dave mentioned, doing these big step outs, drilling to depth, demonstrating the scale of this project, fully funded with $16 million in treasury at the end of May. That was from our financing, we closed in May. And that's funding a 50 to 60,000 meter drill program, which is going to extend through this year and into next year. So that's the day job, right? And we'll keep telling that story about drilling, drill results, and the growth of the project. But the PEA, the snapshot study, what is the project as a mine on what we have right now, the snapshot, it works. It works in what we have right now. And it works really well with really good value and low initial capital costs on the basis of our mined material going to an offsite facility. We've based this study upon Doyen. We worked very well and collaboratively with Iron Gold, thank you, on the milling assessment on Doyen. But there are a number of facilities in the region, and so we're establishing the general parameters for what O'Brien might look like on that general basis, and it works very well. So that's a path that O'Brien can and should pursue, and so we're going to go down that path. So that means environmental baseline work. It means additional engineering studies, mine plan optimizations. It means talking with our neighbors and community members and First Nations and stakeholders, and it means conversations with potential processing partners as well. So those things are going to go in parallel as we go down the path of the O'Brien Gold Project. So that's our webinar. Thank you very much. We can now open this up for questions. As usual, I'm available with that contact information. Hubert is available in that contact information. Christina Pilon, Investor Relations, is also available. And I think we can go to questions. I think Hubert, you have a few some questions.
Yes, got a couple of questions here. One from Paul Sons. Why use 5% for the discount of the cash flow? That seems low.
That's what every gold project developer uses. We in the press release, we gave you the sensitivity table. If you want to use a higher discount rate, feel free. What I've always found the best thing to do is use the same valuation metric that everybody else uses, and you can compare and contrast different projects. And then you handicap the study or the jurisdiction or the technical attributes of the project, how you would like to handicap it. But 5% is the standard in the gold development business, and that's why we've chosen that as our base case.
We have James Shannon. Hi guys. Have you considered other mills? Can your material be processed by the Kena mill owned by Rodon?
So I don't want to talk in specifics about other mills. We did the technical work on the Doyen mill, and so can represent that on a detailed basis from a flow sheet and a metallurgical point of view. But I think in general terms, we've talked about 5 mills in the region that we think we're within a reasonable trucking distance. That's probably understated because I think recent experience with some of our peers in Quebec and Ontario, ore can be trucked a considerable distance. But there's 5 that we consider to be within our immediate radius conveniently. And several of those mills we believe would have capacity and setups which are consistent with our project and the schedule of our project. So we think there are some options there. I mean, obviously we're right next door to 2 of them, Doyen and the facilities of the Laurent complex with Agnico Eagle. So, but I think there's more than one option there, and I should probably leave it at that in terms of the answer.
Okay. Jake Savage at Agentis, I believe, can you provide a color on the 30% total milling margin estimate methodology? And also, what is the CapEx estimate for the vertical conveyor raise bore?
So on the 30% toll milling, yes. So we again, I stress that that's not based upon any contractual arrangement with ourselves and IAMGOLD. That's based upon market precedent rates that were surveyed by Osenko, who were the QP for the financial analysis of the project. So that's built up. That's about $20 a ton, and it's on top of covering our processing costs, our the G&A costs, and also and of course the financial model also assumes that we are paying for capital upgrades to the mill, which is $21 million, which is principally a flotation and recrane circuit. So we think that is fair and not understated. We don't think we're understating processing and G&A unit costs. The study doesn't assume any G&A synergies, which you probably would have. So we think that is fair. On the vertical conveyor, yes, I didn't really specify that, but part of the design of the underground mine includes a vertical conveyor between surface and 300 meters. So the idea is that we are actually, there's a loading pocket into this vertical conveyor. We're delivering it to site that way. This is a developing technology. It's been used in a number of different instances now. And you have a small engine complex at surface to manage that, and you're dumping onto a raw pile, and then you're trucking the ore away. We did a CapEx OpEx trade-off on that with Novexplo as the various merits of using that versus just taking your trucks to surface. And it works very well. CapEx for it, it's within. It's a good question. It's within the $47 million of mining CapEx. I will have to get back. I don't want to give you a number that proves to be inaccurate. So I'll have to get back to you on what exactly that is. But it's not a big ticket item. Because it's a developing technology, it's important for us to have a fallback plan in the mine design in case it doesn't operate to spec. And that fallback would be that the trucks would just continue to surface, right? If we have an issue with the vertical conveyor. But the vertical conveyor, given the production rate, given the design of the mine, is a really good solution for us in that CapEx OpEx trade-off basis. Probably yes. Probably not the not the best answer to that one, but probably the best I can do.
We can get back to Jake with a specific number on that front, I think.
It'll be in the technical report and the breakdown for that.
Mike Demeter, what are the next steps required for IAMGOLD to provide the green light to advance this plan?
What are the next steps? Sorry, for IAMGOLD to
for IAMGOLD to provide the green light to advance this plan.
Yeah, I can't. I shouldn't really comment. I certainly shouldn't speak on behalf of IAMGOLD. We were very happy to be working with IAMGOLD on that milling assessment under that MOU. The MOU is non-binding, non-exclusive, and we don't have a contractual relationship currently with IAMGOLD. On this. IAMGOLD are obviously very aware of what we're doing, and we have active conversations ongoing with potential processing partners. So I should probably leave it at that. What I will say in general terms is that this is what's called in the industry a what-if PEA. What if that mill was available on these terms and operates on that basis on this schedule? We are putting this PEA out with confidence that that is a credible development scenario for this project. We're not whistling Dixie when we if I can use that expression, when we present a development strategy on that type of basis. And we think we also have because of the existence of multiple nodes in the region, there's some optionality on that issue as well. So I think I can give the confidence of that situation in that answer, and I should probably leave that one where it is as well.
We've got multiple more questions. Congratulations on the nice PEA as well. One of the question is more from an exploration perspective, so maybe for Dave. Any update on the potential application of a photon assay tech on future drilling core? Could targeting at the old Thompson Cadillac mine benefit from similar lithology and old level plans there as well?
Yeah, okay, so there's a few questions.
Or still generating.
Yeah, there's you saw the pictures of coarse gold, and there's always a challenge using traditional assaying techniques with coarse gold drilling, and 50-gram assays tend to underrepresent the grade, and the majority of our assay database is fire assay. Historically, we've done some screen metallics, which it does get more representative value in our assays. However, it's not as good as photon, the new technology. So we do think that the grade is underrepresented a bit in areas. So we just kicked off a pilot study, about 200 samples. We sent those in to duplicate pulps, and we're going to see what that comes back as. So yes, we are aware of photon. We're doing our pilot studies, and we'll consider our options and make a plan once we get the data back. Regarding Thompson Cadillac, there is some level plans, etc. there. Expect the geology, it's still the veins at Thompson Cadillac mine are still in the Pichet structural complex. Similar geometries, a lot to learn there. That mine again was mined at a higher cutoff grade. We want to look at it with our new lens of a lower cutoff grade and more tonnage. So it is in the plan to start drilling there early next year, and we have some great targets. I think we can leverage off the information from even the historic brine mine when we're drilling there.
We have a question about drilling costs, so maybe I can take that question. Our drilling costs for any drilling that is shallow, so from surface down to 600 meters, is about $150 to $175 per meter. And for the directional drilling at depth, not including any savings on meter, just going with the dollars per meter, we're in the $230 range there. We're getting close to noon. I think we have maybe room for one last question. I think it's an interesting one. Maybe we can hand on that. Andrew Walker, what is behind the strategy to release the PEA without a lot of recent drilling results, everything since the new resource, which would significantly enhance the economics and NPV of the project?
So the PEA is based upon the milling assessment that was conducted late last year, beginning of this year. And so we thought it was important at this moment in the company's development to show you what this project does, right? This is the first modern mining study, and it's good. And there's real fundamental value here. This isn't an exploration project for the sake of exploration. There's a mine here. And we felt it was very important to make that statement. When you're thinking about your first study for the project, the question you're asking, which is a very good question, always comes up. And you end up being a bit of a tail chasing its own dog, right? So we've got a block model here. We can use this to build a mine. Oh, but we're having drill success. Okay, well, let's do some more drilling. And then let's update the resource and the block model. But then we've got to update the mine design and the mine plan. And so you take time doing that. But then you got more drilling success. And so you got to do that. And then you're in this conveyor belt, right? And so for the first mining study, at some stage, you've got to get off the conveyor belt and make a statement as to what you currently have, right? So that's what we've done, right? It's an important message of ours that it's using the existing resource. So we don't have that drilling in there. And the next time we put out a resource, you know, this is a forward-looking statement, so all caution language applies. It's probably going to be bigger. So this is a project that's growing, and this is a snapshot study. That's an important message. But the snapshot is pretty good, right? So we want to put it out, right? And again, it's the first one, right? The first modern one. There's been scoping studies and back of the envelope type things and other things in the past. But this is really putting O'Brien on the map, right? And it's showing that if you think of it in this traditional Abitibi way as being an ore body that's sending its mined material, got to get my language right, mined material, you don't have a reserve, mined material to an offsite facility, you're generating a lot of value for low initial capital cost. And so we're telling you what that is, just based on what we've already got. The next studies pick up the new drilling. And now we're into the kind of, there'll be another study down the road. Eventually there'll be a feasibility study, and you're into that sequence of studies. But we felt it was important to make that first initial statement of what this is, and it's good. That was the rationale.
Good.
So thanks, everyone. That's exactly 12 o'clock now, more or less. That's been an hour. Thank you for your patience in doing this again. There'll be a recording of this available on our various communication channels, and have a good day.